all can understand when a company wants to sell its oldest inventory before it sells its newer inventory. Companies face the risk of spoilage and obsolescence of inventory every day. The problem with inventory is that in many cases inventory is improved as newer versions come out, or inventory expires over time. We consider this situation the physical flow of inventory. However, when we look at our accounting information, we are not as concerned about physical flow as the cost flow of the inventory that we are holding in our company. So, while we are concerned with the physical existence of inventory, we have to go through a process of determining what the cost of that inventory actually is. In some cases, the costing of the inventory will be different than the actual physical flow of the inventory throughout the period. So let's take a look at some of the different things we have to consider in inventory valuation. Remember, when we look at inventory, we have to determine cost. The cost of inventory is the purchase price plus all the additional expenditures that are being used that will make the inventory items saleable. Therefore, the purchases as well as the shipping, insurance, duties and taxes that are incurred are all included as part of the cost of the inventory. We can identify the unit cost of each of the inventory items by basically taking the total purchase price and dividing it amongst the quantity. Once we've determined what the unit cost is, though, we have to then take a look at how do we account for those costs as the items are being sold. There are 4 different methods that we will use to determine the cost of inventory. A company needs to pick which method they want to use, and they need to be consistently applying that method over time. These 4 methods, specific identification, first in, first out, known as FIFO, last in, first out, known as LIFO, or average cost. Regardless of which inventory system you use, periodic or perpetual, you still need to choose which costing method you want to use in order to value your inventory. Here's an illustration. Crivets TV Company purchases 3 identical 50-inch TVs on different dates at costs of $700, $750, and $800. During the year, Crivets sold 2 sets at $1,200 each. These facts will be summarized below. So in this illustration, there was a purchase on February 3rd of 1 TV at $700, on May 5th for $750, and May 22nd, $800. The company sold on June 1st 2 TVs for $1,200 for a total of $2,400. So if we use the specific identification method, we would look at each individual TV set and assign the actual purchase price that we purchased the TVs from the seller. When we in turn sell the inventory to our customer, we would assign the cost of the specific TV set as the cost of goods sold. So in this illustration, the $700 set and the $800 set were sold to the customer, and the remaining TV set in ending inventory was $750. This is called the specific identification method because we can specifically identify the cost for the specific inventory item. Now this method works very well if we do not sell a lot of inventory, or if our inventory is a high dollar amount. Once we consider volume, the problem we run into with specific identification is that now we have to specifically identify the cost for a lot of different inventory items. We find that very few companies use the specific identification method because we have to specifically identify the cost to every inventory item. So normally, this method is used when a company has very few inventory transactions, or if the dollar amounts are very high and that they are customizable. So most companies use an alternative cost flow method such as first in, first out, last in, first out, or averaging. This is not consistent with the physical movement of the goods. Rather, we want to apply a costing method that makes more sense to reflect how our costs are being incurred. So let's take this illustration for the data of Houston Electronics. Notice here in this particular example, we have transactions where we had purchased inventory on April 15th, August 24th, and November 27th. We started with inventory of 100 units at $10. We had purchases on the 15th of April of 200 units at $11, 300 units at $12 for August, and 400 units at $13 on the 27th of November. We would extend out the units times the unit cost to determine how much the total cost of each purchase are. So in essence, when we're using the periodic inventory formula of beginning inventory plus our purchases, our goods available for sale are 1,000 units at $12,000. Then we go out and we count our ending inventory, and we have 450 units available in ending inventory. We subtract the 450 units in ending inventory from the 1,000 units in goods available for sale, and we see that we sold 550 items. Now, if we extend out the application of the 450 items sold in ending inventory, we would have 400 units at $13 and 50 units at $12. The extended total of $5,080 would be the ending inventory value under LIFO. Once we've computed the ending inventory value, we can subtract that value from the goods available for sale, $12,000, to get the cost of goods sold of $6,200. Now we can prove the $6,200 value by looking at that we sold 550 items. We can take 100 units at 10, 200 units at 11, which gives us 300 units sold, and we need 250 units from the August 24th transaction at $12 to determine how much we actually sold. So we take the $1,000, the $2,200, and then the 250 times 12 to give us the grand total of $6,200. So what we look at in this illustration is that if we layered the various purchases from the beginning to the end of the $1,000 worth of inventory at the beginning, all the way down to what's left at the end of the $5,200, we show that we can determine cost of goods sold by taking the cost of the inventory at the beginning of the period first and keeping the rest of the inventory at the end of the period for ending inventory. The alternative method is opposite to first in, first out, which is called last in, first out. The cost of the latest goods purchased are to be used to recognize cost of goods sold first. So in other words, the most recent purchases are cost of goods sold, and the older purchases are left in ending inventory. This method very rarely follows the physical flow of a company's inventory. So let's try and take a look. We have the same example here of 1,000 units at $12,000 as goods available for sale. We still have ending inventory of 450 items. However, now what we do with the 450 items for costing purposes is use the oldest cost for ending inventory. So we would multiply 100 units times $10 per unit, 200 units times $11 per unit, and 150 units times $12 per unit. We would extend the cost and find that ending inventory is $5,000. If we subtract the $5,000 of ending inventory from the cost of goods available for sale, we would get cost of goods sold of $7,000. Now, once again, we can prove the $7,000 value by working this problem backwards. Knowing that we sold 550 items, we could take 400 items at $13, plus we need 150 items at $12. When we extend out those two calculations, we would come up with $7,000 for cost of goods sold. So this illustration shows that if we layered our beginning inventory plus our purchases of the $1,000, the $2,200, the $3,600, and the $5,200, we would use for cost of goods sold the most recent purchases to determine the cost. The older purchases would end up in ending inventory. The final method for determining cost is called average cost. Now, as the description sounds, average cost spreads the cost of the inventory over the quantities of inventories during the period. So let's take a look at that example again. Once again, if we have 1,000 items available for sale and the total cost is $12,000, the average cost per unit is 12,000 divided by 1,000, or $12 per unit. So if we had sold 550 items and there are 450 items remaining in ending inventory, we would apply both values against the average cost, $12, to get ending inventory of $5,400, or the cost of goods sold as $6,600. Now notice that we're doing this calculation using the periodic inventory method. If we had been doing the perpetual inventory method, we would have to actually recalculate average cost each time the price changes as we purchase inventory over the period. So here's an illustration of what the periodic inventory looks like if we were doing this on an average costing method. We take the $12,000 and divide it by 1,000 units available for sale, which gives us the $12 per unit, and then what we do is allocate it amongst ending inventory and cost of goods sold. So the question is, which method is better for a company? It depends upon what the company is trying to represent. When we have FIFO, LIFO, and average cost, in times of rising prices, LIFO will provide lower net income because cost of goods sold will be higher, where FIFO will provide higher net income because cost of goods sold will be lower. So take a look at this example for the goods available for sale and the ending inventory. Ending inventory for FIFO was $5,800, but in LIFO it was $5,000. When we figure out cost of goods sold, because of rising prices, LIFO's cost of goods sold was higher. When the cost of goods sold is higher, the net income ends up being lower. If you look at average cost provides us with a result that's somewhere in between FIFO and LIFO. The key thing here is that we consistently apply the costing method from period to period. We choose whether to use FIFO, LIFO, or average, and then we stay with that method unless there's some significant reason to make that change. It doesn't mean that we cannot make a change. However, we do need to disclose the significant reason for the change and its impact on the financial statements. So most companies take the position that once they make the selection of which costing method to use, they stay with that method for the rest of their corporate existence. Now, one other issue that comes in valuation of inventory is what happens if the cost of the inventory is impaired. And what we mean by impairment is that the value of the inventory decreases and we do not expect for it to recover. So when the value of the inventory is lower than its cost and it has gone down and we do not expect it to come back up to its cost, we need to write down the inventory to its market value. And in most cases, market value is determined by what the replacement cost is. We do this because we want to make sure that our financial statements are conservative. So in essence, if we have an inventory item that is decreased in value, we need to reduce the cost of the inventory in our accounting records to whatever the replacement cost is. This reduction in the cost of the inventory is expensed in cost of goods sold at the end of the period. So here's an example of the application of the lower of cost or market concept. Assume that Ken Tuckle TV has the following lines of merchandise with costs and market values as indicated. He has flat panel TVs, satellite radios, DVD recorders, and DVDs. The costs are $60,000, $45,000, $48,000, and $15,000. The market values are $55,000, $52,000, $45,000, and $14,000. To exercise lower cost of market, we would look at the cost of the asset, compare it to the market value. So in the case of flat panel TVs, where the cost is $60,000 and the market value is $45,000, we could see that the market value is lower. Now the question is the lower of the market value permanent? If the lower of the market value is permanent, we would want to reduce the cost of the flat panel TVs to $55,000. By reducing the cost to $55,000, we would have to reduce the cost of the inventory and recognize cost of goods sold. When we look at the satellite radios, the cost was $45,000, but the market value was $52,000. So we're not going to change the cost because the cost was lower. When we look at DVD recorders, the $48,000 cost is higher than the market value, so we need to reduce the DVD recorder cost to the market value. The DVD players, the cost of $15,000 is higher than the market value, so we need to take the lower value there. So once we take a look at all those changes, we need to make an adjusting entry to reduce the cost of the inventory to the $159,000 and recognizing it at cost of goods sold. So now it's time to practice. Take a look at how to cost inventory and how to apply lower cost or market.